There is a structural change in inflation due to deglobalization and ongoing supply chain issues that causes. We're going to have a recession. Is inflation going to infinity? Stagflation? There's so many voices out there saying so many things, but how do you figure out the good takes from the bad? What happens if everybody's wrong? Here's my take. I think that economic growth is going to fall sharply at the second half of the year, sharper than people expect. And maybe that changes the equation for the Fed. I think inflation is going to ease off quite sharply too. But I've been in markets long enough to know that we all get it completely wrong sometimes, and I could be dead wrong. That's the power of Real Vision. It's that we host amazing conversations with some of the world's greatest analysts and investors so that our members have the information and analysis to inform their own thinking. Over the last weeks, we've published some incredible conversations about what's ahead and how to invest against it. In this video, we've distilled several of them to their key takeaways to get you up to speed quickly. What's your big picture view, and then we'll start digging into some stuff as we start chatting.
So I think kind of like how COVID-19 accelerated a lot of trends that were probably already going to be in place anyway, I think the recent military conflicts we're seeing are kind of accelerating some of the problems that were already mounting. And so, for example, we already saw Europe have some energy issues even before any of this conflict broke out, and some of that was now accelerated. I think same thing for food insecurity and things like that. And essentially, I think what we're seeing is a slow kind of unwind of the global monetary order that's been around for the past 50 years or so, and moving towards a more bifurcated world, where we have maybe a little bit more decentralized payment channels, maybe more decentralized choices of storing value, as well as supply chains themselves becoming more bifurcated, because we're seeing, food protectionism, commodity protectionism, commodity, different sort of trade happening around these more like alliances rather than in a global market. Most inflation is transitory, but transitory can last for years in inflation's case, right? So the 70s were transitory, but it was, it was long enough that, it wasn't really transitory in terms of a trading perspective, an investment perspective, a lifestyle perspective. And so my base case for a while has been that the 2020s would be more inflationary than the 2010s. The exact height that we're going to reach depends on these variables that are hard to predict ahead of time, like whether or not there'll be war, whether or not there'll be factors like that. And so I think now we're at risk of hitting some of the higher levels of that kind of range, that probability range that I think was going to play out anyway. And now we're kind of on the higher side. So I would characterize this kind of like the 70s or the 40s, in the sense that we are going to probably have a pretty persistent amount of inflation. But even that, it won't be a straight line. If you looked at the 40s, you had price controls at some point. 70s, you had, price controls, you had wage controls. There are periods where even in an inflationary decade, you can have disinflationary periods, right? So you get these waves of inflation. And I think the 2020s will be no different, where you could get, for example, a de-escalation of some of the big trends we're seeing now. Things can be overdone, traders can pile in, things get too consensus, and then there's some sort of kind of unwind of that, and then you can have another spike up. We've already seen this happen in European natural gas, for example. There are periods where it got overdone, came back down, and then got even more overdone. And I think you could have the same thing on kind of a longer trend line.
One of the things I'm thinking of is I've been looking at thinking that the 1940s is probably the most similar period, less so the 70s. It's the post-war. It's kind of the same kind of structure we've got now. GDP was volatile. Inflation at first took off and then kind of eased over time once, we started to see manufacturing pick up and all of that. We saw yield curve control. We saw a lot of fiscal stimulus.
The key financial consequence of secular stagnation was the trend decline in interest rates. We have seen for 4 decades the cycle in interest rates in the US. Every cycle low has been lower than the prior low. Every cycle high has been lower than the prior high. So unless, and you weren't doing this, I wasn't doing this, we weren't trading markets in the 70s. Unless a listener was watching markets in the 70s, none of us has seen a cycle where the peak in the 10-year Treasury yield was higher than the prior peak. I think that's coming. I think in this cycle, we get the peak surpassing the prior peak, and that's the most concrete outcome of these secular changes. Now, Obviously, what's happening in Ukraine complicates that, and there are tail risks there that I appreciate. If we can put that to one side, which is, in a real-world sense, almost impossible, but prior to Ukraine, I was absolutely telling people that we would see interest rates in the US go higher than we have seen for several years. It would be the first time that we've seen a cycle peak exceed the prior cycle peak. It's still my base case, but with a little less conviction because of what's happening in Ukraine.
It feels like that's a weaker euro as well. But I don't know, how are you thinking through, what does this mean when you say it's expensive?
It's expensive because if you take the politicians at face value, which I think on this one we probably should, they're all going to have to secure their stockpiles of gas, and we could go down the commodity list, and not forgetting fertilizers as well, which are kind of important. And that's going to underpin prices. You can argue whether the Fed's behind the curve or not. But you would have thought, one of my priors was, if the Fed's going to hit things hard, as they are, credit would be falling apart like a bad meatloaf, right? And there's been some widening in credit. There's been higher risk premium in credit. High yields been hit a bit, but it's all come back down. You have, of course, seen a very abrupt rise in 30-year fixed rate mortgages in the United States, which at some point will put a bit of a brake on the ability of US households to refinance and put a bit of a crimp on consumption as intended. But mortgage-backed spreads have widened a little bit. Well, they've widened abruptly in some parts, but nothing compared to averages of the past decade plus. And it's just surprising that the Fed is so overtly hawkish and people are like, nah, doesn't matter. And I'm like, we must be so close to the point where this does matter. If the Fed's going to be really hawkish, and you're making a good point, if the Fed's going to be really hawkish, then you'd expect, I think, the dollar to be a lot stronger. You'd expect credit generically to be a lot wider. But on the other hand, if the Fed's hawkish because the underlying economy is solid, which, believe it or not, I think it still is, then credit may not widen too much, because if the economy is on a solid footing, the cash flows will be there for all these borrowers to service their debt, and in some cases refinance if they need to. But I'm thinking more of equities, okay? We've got to be close to the point, I imagine, where some really important companies say, look, I'm sorry to report this, but we are running into severe supply chain squeezes, and in order to ensure production and manufacturing is unaffected, we have had to pay up for inputs, and I'm sorry to tell you, that is going to reduce our profit margins. Thanks for coming.
Feels that in that world, the Canadian dollar and the Aussie dollar do well because they are the secure supplier.
And I'll just add quickly, we don't have time to go into it today, but there is a massive structural short in the Australian dollar. Aussie super funds, gigantic global investors, within, I'd say 3, maybe 5 years, Australia will be one of the largest creditor nations in the world, which is astonishing when you think about how we used to view the Australian dollar and Australia's current account deficit and everything else, but it's true. And unsurprisingly, given the size of these gigantic Aussie super funds, they have to put a lot of capital to work overseas because Australian domestic markets are just not big enough. And nearly all of that is unhedged. All of it. So that's why I'm starting to think, I know it sounds crazy, like, should I be buying the Aussie versus the renminbi? And on top of that, as of now, although there might be some last minute changes, as of now, there's regulation in Australia which will require all Australian super funds to report all their positions line item by line item, including their hedges. What? If one Aussie super fund, just one, says, I want to fully hedge my currency exposure, it goes straight to 80 cents. And if two do it, right, it's served them well. Being unhedged short Aussie and investing in all sorts of global assets is like win-win. You've got the capital appreciation on your dollars or euros or infrastructure, and you've got the currency going down. Happy days. But I'm just keeping in mind that there's a unique structural short in the Australian dollar. it does not mean anyone watching this should go out and start punting the Australian dollar, but they should start thinking about long-term structural winners.
There is a huge amount of confusion and polarity going on right now in where we are, if things have changed. Just talk us through your top big picture view.
Okay, so going back to that secular view, I'm of the opinion that the long-term secular decline in growth, and as crazy as it sounds, the long-term secular decline that we've had in inflation is still very much intact. Because the two biggest factors are demographics, or if one factor would be demographics, and the demographics have continued to deteriorate. Nothing has changed with the demographics except they've gotten worse, right? We've had projections from 2019 and 2020 of where the demographics would be. And the last 2 years, not just the United States, everywhere, the demographics are coming in much worse than these expectations were forecasting. So there's going to be a continued drag from the demographic vector that's almost unquestionable. And then the debt load has obviously continued to balloon post-COVID. So the secular force of debt and demographics, I think, is still very much intact. And we can get into this, but I feel that the cyclical rebound was, of course, related to some of the stimulus that was sent out. But more so than the stimulus, there was a radical shift in behavior that I think was somewhat unrelated to the stimulus. It was more of a behavioral shift because of the COVID lockdowns. So as you know, Raoul, from your business cycle work, that the two biggest portions of the two biggest factors that drive the cyclicality of the cycle are housing and durable goods, right? Housing or manufacturing. And after COVID, we saw an unbelievable secular shift in housing, right? Everyone was leaving cities and moving to suburbs. That was a shift that was more of a behavioral aspect. I don't think anyone was moving from the cities to the suburbs because of a $1,200 stimulus check, right? That was a behavioral shift because people no longer wanted to be in a closed space. Similarly, people had to change their spending habits, not by choice, mainly by necessity. You couldn't spend money at a restaurant, so you had to spend money doing things at home. We had the largest spike in housing and durable goods as a percentage of GDP almost ever. And that put in place an unbelievable cyclical force behind the economy, and that's what wrecked supply chains, some of which we're dealing with now. What's going to happen now, and where the leading indicators are moving, is that the housing is going to start to soften under the pressure of these rising mortgage rates that we're seeing. And the durable goods cycle is also starting to roll over. We're seeing indications that the manufacturing is starting to soften because prices have moved too high, real income is declining, and consumers are going to start stepping back from this durable goods.
And inventories are super high as well now.
Exactly. Companies are going to find themselves with way too much inventory as a result of this big pullback that consumers are going to have because their real income's declining. So wrapping all that together, we have this secular decline that's still in place. We're coming off the back of what was an unbelievable cyclical upturn. But now we're going to start to have we're going to move down the backside of that cycle, right? At the same time that the Federal Reserve is tightening, and quite aggressively, might I add. So that's going to set up what I think is a huge risk pocket in asset markets. I think that the internals of the equity market are saying this loud and clear.
So what you're suggesting is that, okay, the yield curve has gone, well, it's negative in 2-10 swaps today and 13 basis points in the normal bond yield curve.
And 530 spot has inverted today, I think, as well.
Yeah, so the market is telling us this, but nobody believes it yet.
Right.
So the argument goes that there is a structural change in inflation due to deglobalization and ongoing supply chain issues that causes. What's your view on that?
Okay, so I don't believe that this is a structural shift in inflation. I think that this is a long-lasting cyclical change, because if we have higher prices across various goods, right? But the trend potential of the economy has not changed. So people's income is not necessarily changing because oil prices went to $150 a barrel. All that's going to do is it's going to squeeze real incomes even harder. And whenever we look at the impact of these policies, specifically government policies, Raoul, we need at least a 3-year window to analyze the full effect, right? So the inflation really started to get out of control in March of 2021. That was the third stimulus check that kind of was overkill, and that's what blew everything out of proportion. We've only been in this for about a year now. Now, living through it for a year is quite a long time, but we haven't seen the backside of this policy yet.
So if you're looking forwards using your framework, where do you see the range in bond yields? Does the chart of truth continue and we go even lower? Which was my base case, but I'm starting to think that maybe they go sideways in, let's say, a 1 to 3% range for an extended period. Most other people now, and everybody pretty much I've interviewed recently, all think it breaks higher. How do you think this plays out?
Right. So I think that if we look forward 12 to 18 months, I think that that chart of truth that you always point, I think it'll continue to prove true, where that decline will still be in place. I don't think that bond yields break out to out of that channel and rise on a secular basis, because as the yield curve is suggesting, as some of my forward-looking indicators are suggesting, we're going to have a continuation of this downturn in the growth rate cycle. And that's going to lead to what looks like to be recessionary conditions. And we know recessions kill inflation, right? So I do think that once the cycle fully turns lower and recessionary conditions prove to be evident, we'll see those curve inversions deepen until the Fed is forced to pivot, not because of higher inflation, but they're going to have an employment problem to deal with also.